Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at KLR Technology Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we get into the actual analysis, I do want to mention we have a special 14-day trial link below in the description for StockOracle.
Right, and just a quick reminder for everyone, StockOracle is an AI-aided stock research platform. It is not, financial advice, it's not a trading signal service, and it does not provide real-time market data.
Exactly. Also, just so you know, that link down there is an affiliate link, so the channel may earn a commission at no extra cost to you. And please remember that StockOracle's AI insights and valuation estimates can sometimes be incomplete or just wrong, so always verify important facts for yourself.
Absolutely, you always have to do your own homework.
Yeah, always. So imagine designing cutting-edge, ultra-high-power battery systems for the International Space Station, effectively doubling your revenue in a single quarter, and then having to report a $28 million net loss to your shareholders. And all of that just because Bitcoin had a bad month.
I mean, it completely breaks the traditional cause and effect model of evaluating a manufacturing business. You're suddenly no longer just analyzing supply chains and customer acquisition. You're trying to decipher this highly leveraged crypto treasury that just happens to have a factory attached to it.
It is so bizarre. And that is the central reality we are unpacking for you today.
Yeah.
We are looking at a microcap tech company called KULR Technology Group, based on recent market data and analyst research. And for anyone listening who wants a masterclass in why you can never, ever just look at top-line revenue growth to build wealth or understand a company's health, well, this is it.
Oh, for sure. It's a perfect example.
We're going to explore this really fascinating tension between the tangible, metal and lithium reality of a factory floor and the invisible, chaotic volatility of a digital ledger.
Yeah, so to set the baseline here, KLR operates in a highly specialized, almost futuristic industrial niche. They design and manufacture safe, certifiable, ultra-high-power lithium battery and energy management systems.
Right, so we aren't talking about AA batteries here.
No, not at all. The environments they're targeting are extreme. We're talking space exploration, defense contracts, advanced drone aviation, and the massive power density requirements of modern AI data centers.
So on paper, they are positioned at the absolute intersection of the world's most aggressive growth sectors, space tech and AI infrastructure.
Yeah.
And if you look purely at their Q1 2026 earnings report, I mean, that narrative seems to be playing out flawlessly.
It really does. The surface fundamentals present this incredibly bullish, classic hypergrowth story. The top-line metrics are undeniably strong. In the first quarter of 2026, KLR's total revenue jumped 98% year over year, hitting $4.8 million.
Wow, essentially doubling.
Yeah, nearly double. And if you isolate just their product sales, like the actual physical batteries and systems leaving the facility, that segment grew 84% to $2.1 million.
That's the kind of top-line expansion that usually, sets off fireworks in the market.
Yeah.
But the metric that really caught my eye in the data was the gross margin. A year ago, their gross margin was a microscopic 8%. In Q1 2026, it leaped to 29%.
Yeah, that's a massive jump.
How does a hardware manufacturer nearly quadruple its profit margin on physical goods in just 12 months?
Well, it really comes down to the mechanics of transitioning from a bespoke research and development phase into initial, scalable production. When a company like QLR is building one-off, highly customized power systems for early testing, the unit economics are just terrible.
Because every single unit is basically a science experiment, right?
Exactly. Every battery requires massive engineering overhead. So the jump to 29% margin suggests they've finally started standardizing their product lines. Things like the KULR One Space and KULR One Max platforms. They are distributing those heavy, fixed engineering costs across a much larger volume of standardized units.
It's the difference between hand-building a prototype in a lab versus running a continuous assembly line. Your cost to produce the 100th unit is a fraction of the cost to produce the first one. So they are selling twice as much product and keeping a significantly larger slice of the pie on every sale. It sounds like they have finally turned the corner.
That is precisely what the headline numbers want you to believe. But, however, the income statement tells a much darker story the further down you read. Despite that 98% revenue growth and the improved margins, KULR's core operations are still burning cash at a severe rate. They posted an operating loss of $7.4 million for the quarter.
Okay, so even with the improved unit economics, the sheer cost of keeping the lights on, paying the executive team and running the sales department, their SG&A expenses, is entirely consuming that revenue and then some.
Yeah, entirely.
They brought in $4.8 million, but they spent over $7 million just operating the business.
Right. Their SG&A alone was $6.5 million. Now, to be fair, that operating loss is actually a 22% improvement from the prior year, so they are tightening the belt slightly. But this is where the financial reality fractures completely.
Yeah, this is the wild part.
Despite narrowing their operating loss, the company's total net loss for the quarter widened massively. They reported a net loss of $28.1 million. That equates to a loss of 61 cents per share.
This is the massive discrepancy we teased at the start. I want you to listen to really picture this math. A company generates $4.8 million in total revenue. They lose $7.4 million actually running their operations. Where on earth does a $28 million total net loss come from? That implies over $20 million simply vanished from the balance sheet.
Yeah, and it didn't vanish into the factory, and it wasn't spent on lithium or R&D. That missing $20.8 million was entirely driven by a non-cash mark-to-market loss on the company's Bitcoin holdings.
Wait, a microcap battery manufacturer is holding so much crypto that a bad month for Bitcoin completely dwarfs their actual operating business.
I know, it's wild. It highlights a highly unusual, highly aggressive treasury strategy. According to the Q1 earnings call data, KULR held approximately 1,085 Bitcoin on their balance sheet.
Wow. Over 1,000 Bitcoin.
Yeah. And to understand how this breaks their income statement, we have to look at GAAP accounting rules for digital assets. Under current regulations, a company holding crypto must mark those assets to market value at the end of the reporting period.
Right.
If the price of Bitcoin plummets during the quarter, the company is legally required to record that drop as an impairment loss on their income statement, even if they haven't sold a single coin.
So it's just a paper loss. It's an accounting ghost.
Yeah.
They still physically have the Bitcoin, but because the broader crypto market took a hit, their official financial statements make it look like the company is bleeding to death.
Exactly. It completely obscures the actual performance of the battery business. If you are an institutional investor trying to model KULR's future cash flows based on their data center contracts or their space tech, your model is constantly being blown up by the macroeconomic volatility of the crypto market.
The underlying manufacturing improvements are basically being held hostage by Bitcoin's price action.
Yes.
Which raises a huge fundamental question. Why does a $20 million a year battery company have a massive Bitcoin treasury in the first place?
Well, often in the microcap space, traditional financing is incredibly expensive or just outright unavailable. A company burning $7 million a quarter might struggle to secure favorable terms from a major bank. So crypto treasuries are sometimes used as alternative collateral. And we saw the mechanics of this play out recently. The data details a credit facility KULR had established with Coinbase.
Okay, let's break down how a Coinbase credit facility works for a publicly traded manufacturer. Because I imagine they aren't just trading meme coins on an app, right?
No, definitely not. A facility like that allows KULR to borrow institutional cash against their Bitcoin holdings without triggering a taxable sale of the crypto. They pledge the Bitcoin as collateral to get US dollars to fund their factory operations.
Got it.
The risk, of course, is that if Bitcoin's price falls too far, the collateral value drops and you face aggressive margin calls.
But they actually resolved this debt recently, right? There was a major move in July.
There was. Between July 9th and July 23rd of 2026, KULR made the strategic decision to sell approximately 333 Bitcoin at a weighted average price of roughly $64,538 per coin.
Okay, so that's a decent chunk of change.
Yeah, it generated about $21.5 million in gross proceeds, and they immediately used those proceeds to fully repay the $20 million Coinbase credit facility.
So they crystallized some of those previous paper losses. But in doing so, they executed a massive deleveraging event. They paid off their institutional crypto debt. And as of late July, they are left with a largely debt-free balance sheet while still holding about 760 Bitcoin.
That's right.
You would think the market would reward that kind of balance sheet cleanup. I mean, you cleared a $20 million debt overhang.
Mm-hmm.
But when we transition from the balance sheet to the technicals, the stock chart, the market's reaction tells a completely different, much darker story.
Oh, the technical analysis is brutal. Despite the Q1 revenue growth and the July debt payoff, KULR's stock is trading near $2.80. That represents a 55.6% collapse from its 52-week high of $6.30. And the structure of that decline is deeply concerning.
It's not just a single bad earnings reaction then. It's a systematic bleed.
Yeah, we are seeing a textbook pattern of lower highs. Every time a press release generates a brief rally, the buying pressure exhausts itself at a lower price point than the previous rally. And the technical indicators also highlight a severe lack of liquidity.
How bad is the volume?
Well, the 10-day average volume is under 1 million shares, and the current volume regime is sitting at about 0.47 times its 3-month average.
Okay, let's translate that volume regime metric for everyone listening. When a stock is trading at 0.47 times volume, it basically means trading activity has been cut in half.
Exactly.
The institutional buyers, the funds that actually move the market, have essentially left the room. What you are left with is a stabilized price around $2.80, not because people are confidently accumulating shares, but because the only people left trading are retail investors passing the same illiquid shares back and forth.
It signifies a complete lack of conviction in the market. Furthermore, plus the stock carries a beta of 2.36.
Oh, wow, that's high.
Yeah, in practical terms, beta measures a stock's volatility relative to the broader market. The S&P 500 has a beta of 1. A beta of 2.36 means KLR acts like a magnifying glass for broader market anxiety. If the overall market dips 1%, KLR is statistically likely to violently swing down 2.3% or more. It is an incredibly fragile asset to hold in a volatile macro environment.
I want to play devil's advocate here and push back on the negative sentiment, because the analyst data notes 2 independent sell ratings from Seeking Alpha analysts alongside a generally neutral to cautious market consensus. But we're talking about a company that just secured a contract with Icarus Robotics to power a free-flying robotic platform for the International Space Station.
Sounds amazing, I know.
Right. They are putting hardware in orbit. They're expanding into AI data centers. How can Wall Street analysts justify a sell rating on a company whose technology is literally being trusted in the vacuum of space?
It's a crucial distinction to make. Having phenomenal world-class engineering does not automatically equate to having a viable commercial business model. The analysts aren't doubting that KULR's batteries work in space. They're doubting the company's ability to monetize that technology without destroying shareholder value in the process.
Okay, so what exactly is the bear case built on?
It's built on 3 pillars. First, the structural operating losses losing $7 million a quarter is just unsustainable for a company of this size. Second, the valuation. Even after the 55% drop, they were trading at a price-to-sales ratio of 6.83.
Which is astronomical for a hardware company with a negative 383% net margin. I mean, if they were a high-margin software as a service company, a 6.8 multiple might make sense, but building physical batteries is capital-intensive.
Exactly. And that capital intensity leads directly to the third and really the most destructive pillar of the bear case. A documented history of aggressive shareholder dilution via at-the-market or ATM equity offerings.
For those of you listening, if you invest in microcaps, you really need to understand the mechanics of an ATM facility. It is not like a traditional stock offering where the company announces a specific number of shares at a specific price.
No, it's much more subtle.
Right. An ATM acts more like an automated valve attached directly to the open market. When the company needs cash to fund that $7 million operating loss, they use the ATM algorithm to quietly create and sell new shares directly into the daily trading volume.
It is a relentless, often invisible pressure on the stock price. Let's say KULR releases a fantastic press release about the International Space Station. Retail investors get excited, and they start buying the stock.
Yeah, driving the price up.
Exactly. But the ATM algorithm sees that surge in buying volume and automatically starts selling freshly printed shares into that demand. It artificially caps the stock's upside while simultaneously shrinking the ownership percentage of every single existing shareholder.
You are constantly slicing the pie into smaller and smaller pieces just to pay the electric bill at the factory. One of the analysts actually labeled the company an expensive one-stop hype shop, which is incredibly harsh.
Very harsh.
But when you look at the mechanics of using space contracts to generate retail interest, and then using an ATM facility to sell stock into that interest, you can see exactly why institutional money stays away.
The market is currently pricing in a massive future growth premium that KULR has not yet proven it can achieve at a commercial scale. Their economic moat is described by analysts as narrow and highly technology-specific. They dominate in bespoke, ultra-safe applications. But translating that niche dominance into mass market profitability against better capitalized giants in the broader energy storage sector, that's a monumental hurdle.
Okay, so we've mapped out the minefield. The gap accounting nightmares, the ATM dilution, the massive cash burn, and the absolute lack of institutional volume. But let's look at the path forward, because if you are analyzing a distressed microcap, the entire thesis rests on identifying catalysts. What could actually force this narrative to flip and trigger a legitimate turnaround?
Well, the primary operational catalyst is the transition from that bespoke R&D phase to genuine mass production. According to the research, KLR has secured a new 25,000 square foot manufacturing facility. The production lines in this facility are expected to begin operations in the third quarter of 2026.
So we are looking at late summer, early fall of this year for them to really flip the switch on the factory floor.
Right. That facility represents the proving ground. If they can ramp up those automated production lines on schedule, and crucially, if they can convert their backlog of customer commitments into recognized high-margin revenue, that provides the tangible evidence of commercial scaling that Wall Street requires.
But the margin for error here is essentially zero. The analysts don't just vaguely suggest they need to do better, they explicitly lay out exact upgrade triggers. Like, the specific financial hurdles KULR must clear for analysts to stop telling people to sell the stock. Let's
Yeah.
walk through these, because it is a steep, steep climb.
It really is. The first trigger is revenue consistency. KULR must demonstrate 2 consecutive quarters of sequential revenue growth above 25%. Meaning Q2 cannot just be better than last year, it must be 25% higher than Q1, and then Q3 must grow another 25% on top of that.
They need a compounding growth engine, not just a one-off lucky quarter. What's the second trigger?
Margin defense. They have to prove that the jump to a 29% gross margin wasn't just a statistical anomaly or the result of a single, highly profitable defense contract. They must sustain their gross margins above 25% across multiple quarters of mass production.
Which means the new 25,000 square foot facility has to run incredibly efficiently from day one. You can't have supply chain bottlenecks or excessive waste, or that margin just collapses back to single digits. And the third trigger?
Operating discipline. While trying to achieve 25% sequential growth and running a brand new factory, they must simultaneously shrink their operating losses below $5 million a quarter.
They have to scale up their production and sales without linearly scaling their expenses. They basically need to do more with less.
Exactly.
But all of these operational triggers feel secondary to the final requirement regarding their capital structure, the ticking clock on the dilution.
Yeah, the data highlights a hard deadline. KULR currently has a pause on their ATM equity offering program, meaning they aren't currently diluting shareholders to fund the business. However, that pause officially expires on September 30th, 2026.
The ultimate test of their turnaround. If they reach October and immediately turn the ATM machine back on to start dumping shares on the open market, it signals to everyone that the core operations still cannot sustain the business.
Right.
To trigger an upgrade, management must extend that ATM pause indefinitely, proving they can fund their growth through organic cash flow or by leveraging their remaining 760 Bitcoin rather than punishing their shareholder base.
Which is why the timing of this analysis is so critical right now. We are standing right on the precipice. With Q2 2026 earnings expected in mid-August, the market is about to receive its first real data point on whether the Q1 improvements were the start of a durable trend or merely a temporary fluctuation.
Right.
As management themselves acknowledged, one quarter does not make a turnaround. If Q2 shows stalled revenue growth, or if those gross margins revert to the mean, the bullish narrative disintegrates entirely.
Given the sheer complexity of this situation, the booming top line masking a massive operational burn, the deleveraging of a highly volatile crypto treasury, the threat of impending dilution, and this impending catalyst of a new manufacturing facility, what is the final synthesized verdict from the analysts?
The consensus assigns KULR an overall rating of 4, placing it firmly in the neutral band, so a bullish score of 4. It is not currently viewed as an investable asset for traditional portfolios. It is categorized as a highly speculative, early-stage turnaround story that demands really close monitoring.
So it's a wait-and-see situation.
Exactly. The progress is acknowledged. Paying off $20 million in institutional debt to Coinbase is a massive step forward for their balance sheet. And the leap in gross margins shows real potential pricing power.
Sure, credit where it's due.
But when you weigh those localized victories against a structural $7.4 million quarterly operating loss, the systemic risk of holding hundreds of Bitcoin, and a technical chart that shows zero institutional support, the evidence of sustained viability simply isn't there yet. The long-term view is that the probability of a successful recovery is moderate at best. Management has to execute flawlessly across engineering, mass manufacturing, sales, and capital allocation all simultaneously.
And this brings us back to why we chose to focus on this today. It forces you, the listener, to look past the headline numbers. A 98% jump in revenue sounds like an unassailable victory. But when you lift the hood and examine the mechanics of how a company funds itself, you see how easily a booming top line can be eclipsed by the chaos of a crypto treasury and the slow, grinding destruction of shareholder dilution.
It really reinforces the reality that buying a stock ticker means buying into a deeply interconnected financial ecosystem. One where, an accounting rule regarding digital assets can dictate your net income more than the actual factory you built.
Exactly. And I want to leave you with a final provocative thought as we wrap up today's talk. We are observing a growing trend in the microcap space, where deeply unprofitable tech and manufacturing companies are adopting cryptocurrencies to park their cash or secure alternative financing.
Yeah, we're seeing it more and more.
As this practice normalizes, you have to ask yourself a critical question before allocating capital. When you buy a stock like KULR, are you actually investing in the underlying innovation of space-grade batteries? Or are you inadvertently buying a highly leveraged indirect crypto proxy that just happens to have a manufacturing side hustle? It's a fascinating structural shift in how small companies survive, and definitely something to think about the next time you encounter a stock chart that seems completely detached from its core business.
It's definitely a wild new world for investors to navigate.
It really is. Remember, KLR sits at a bullish score of 4 right now, firmly neutral with a very speculative long-term view. If you found this breakdown helpful, please remember to subscribe, like, and leave a comment below. And if you want to dig into these kinds of complex setups yourself, don't forget to check out that special 14-day trial link for StockOracle in the description. Thanks for listening to Smart Wealth with Joshua.